KATLEGO is a senior consulting actuary at Deloitte within the actuarial and insurance solution space. He possesses industry experience around non-life, life insurance, and also investments. He has held numerous leadership positions in the insurance industry, including serving as an executive at a non-life insurer. He's an established speaker across a wide range of topical issues and has passion for using his technical skills to solve complex business and regulatory problems. And Michael, a qualified actuary as well, a fellow, is part of the managing body within Deloitte, actuarial and insurance solutions practice. He has built up experience and expertise across various technical areas, including short-term insurance pricing, IFRS 17, SAM. Michael has a deep passion for coding and is inspired by the value it adds in his areas of experience. Welcome, both, and over to you.
Thank you, Simba. Can you hear me clearly? Thank you. I don't know what this is for, but I will use it well. Good afternoon, everyone. Are you excited to be here? That's not convincing for me. Are you excited to be here? Okay, a bit more, that's fine. I'm very stressed to be on the stage right now. I'm very stressed because I was planning that before our session came up, I'll make a dash and because I drank a lot of coffee and needed to go to the bathroom, I forgot to do that. So this is going to be the shortest presentation in the history of the convention, 50 years later. Simba, what is the record? I just want to know what we're working towards. What is the shortest?
I haven't thought about it. I haven't seen it, but probably
8 minutes, 52 seconds.
I made 8, yeah.
I think we'll do 6 minutes.
Good.
Thank you. But we are excited to be speaking to you. We're going to be speaking on risk-based pricing in Africa, focusing on the short-term insurance side. Thank you for the introduction from our hosts. And just a bit more context, Michael and I are part of the Deloitte Actuarial and Insurance Solutions team, and we are involved in a lot of actuarial and wider insurance projects from a consulting standpoint. Michael has done a lot of work in Africa. He's very passionate about getting into the coding, building models, and he has done that for clients in Botswana and Lesotho in Zimbabwe, as well as Kenya. I've also similarly been involved in advising clients across the rest of Africa, including Botswana, Kingdom of Eswatini, Nigeria, Ghana, Zimbabwe as well. And so it is with that backdrop that we thought there might be value from us having this conversation at the convention today around what does the landscape look like from a wider Africa standpoint as far as risk-based pricing is concerned. And so just to highlight, we are based in the Johannesburg office in South Africa, and so we have a lot of clients that we are working with based in South Africa, but we felt it's important to get a perspective of the wider Africa outside of South Africa, and we'll speak to that in a bit more detail later. So from an agenda standpoint, what are we going to be covering today? We will be just giving you some background as pertains to risk-based pricing. Where do we come from? How did we get here? We'll then explore some of the challenges that exist in an African space, in an African setting and context. We will then speak to what really today is about for us, and that is the survey results. And it is very important. Someone once said to me that how do you, KATLEGO, claim to understand and know the problems your clients are facing if you don't chat to them? So that's why we felt a survey is important in this regard. We will then unpack opportunities as well as benefits that risk-based pricing can bring forth, and we'll close off hopefully with some time for questions. Michael, so maybe just kick us off. Where do we come from?
Can you hear me? There we go. I have to speak very deeply into the mic. Okay. So looking back at since 1960s, the theory behind generalized linear models was really developed, but the computational power to really make the theory and the application of it pervasive took quite a few years. So we really only started seeing in the 1980s that the computational power of computers catching up with the theory and mathematics for fitting generalized linear models. Then Again, this trend tends to continue. We see another theory being developed in terms of neural networks, quite a well-known methodology for identifying the most predictive variables and rating factors in pricing, and that has become quite known recently. And then in terms of the availability of data to fit these neural networks and make use of them, we see again that there's been significant improvements in the availability of data in this age of big data that has really made it possible. And then last but not least, looking at innovations in terms of cloud computing, a lot of small insurers do not have the resources, financial resources to acquire expensive data systems, and today they can gain access to reliable data on a subscription basis via cloud services. And then what we see today, which is the norm, is actually the use of machine learning in insurance pricing. It's actually become quite uncommon to hear of some insurers making use of generalized linear models. So having looked at this progression over time and these efforts that have really gone into making models more accurate and helping insurers define more granular segments of risk, we thought we would reach out to our African neighbors and just find out to what extent are they really making use of these innovations. And so we just had a few conversations. The first question, the answers that we really hear to this is, our competitors are not doing this, so we're quite reluctant to be the first ones to make the move. Then we also see that the claims data tends to not be granular enough, or they feel that there isn't really enough volume of data for certain lines of business to develop a model. And then also the sales force plays a significant role in terms of who are the clients going to be, and whether sales will actually take place. So if your business is too complex, the sales force isn't always very keen to get behind you. And then the cost of development and finally obtaining expertise is quite prohibitive, and is something that will require a bit of convincing for institutions to invest more into developing the infrastructure to get to the point of making use of it.
I think we're just having a bit of a glitch on our presentation. Hopefully we'll get back into it if we can be assisted by the IT team at the back.
Do you need the team to go to the next
All
slide?
right.
To the next slide.
Yeah, so, all right, so that's back. Okay, so we can actually just jump in and go into the survey, and we've told you why we felt it's important for us to do the survey, and we'll just speak to how we've put it together, what do we feel are some of the limitations for the survey, as well as the next steps.
So our survey was comprised of 19 questions, and we disseminated the survey to respondents in 10 different countries, and it was split into 4 different sections. It took about 5 minutes to complete and was very specific to general insurance. So KATLEGO will speak to the limitations and the next steps that we think would be great in terms of our survey.
Yeah, so our survey is ongoing. We reached out to clients that we work with, and in this case, a client or a contact would be essentially completed on behalf of an organization, and that is what we have on the second bullet there. And we also at this stage can't draw conclusions on a country level. So we had 17 respondents, and I think our results reflect 1 or 2 less from the 17. But because of what we were trying to get to, rather than these high-level observations that we have made, we felt it's concrete enough as a starting point to help then consolidate that further as we go. And so we are hoping that we will get sufficient conclusions to then be able to also draw conclusions at a country level, which we can't do at this stage. Obviously, our responses were limited to selections. We didn't leave it as an open commentary section. And yes, I have mentioned the survey is ongoing. From a next step standpoint, we are hoping to receive additional responses and have a more comprehensive, holistic view of where the industry is, where organizations are, and then do the consolidation at a country level. So maybe just to summarize and give you the overview from a demographics standpoint of our respondents, it looked as follows. So just to avoid bias, we work a lot more with South African insurers, and so in the survey respondents, we do not have any respondents from South Africa, but it was from the rest of Africa, and you can see their demonstration of where most of our respondents came from, with a dominance coming in from Ghana, close to 30%, and then Kenya as well. And then we have a couple of responses that came from organizations in Botswana, Lesotho, etc. And as far as the organizations that are represented are concerned, we found that it's a lot more mature entities. So most of the respondents indicated that their organizations have been in operation for 10 plus years. And even for the 20% outside of that who were less than the 10 plus years, they were in existence for between 6 and 10 years. And then from a split as far as insurer versus reinsurer is concerned, the majority of our respondents were insurers, roughly 87% being insurers and then 13% being reinsurers. So 87% insurers, 13% reinsurers. And then, so what were we putting to our respondents? So the first question that we have asked, which will come up to the screen, is, does your organization have a short-term insurance new business pricing model? So a large portion of the respondents said that they do not, and they, in fact, just implement a set of rules. So probably rating tables and the like. And then 27% of the respondents said, yes, they do, but it's only for some of the lines. It's interesting to see that 7% of the respondents are doing that for all of their lines of business. We then asked in terms of renewal pricing, whether in addition or outside of new business pricing, do they have any models for renewal pricing? And we found that 60% are applying a set of rules. We still see 7% of those entities that had a new business pricing model also have a renewal pricing model. And then 20% said that they have it for some lines of business. As to the frequency of updating their models, we asked how frequently does your organization update its short-term insurance pricing models and methods? By and large is on an annual basis, 40% of the respondents. 13% of the respondents did say never, which is interesting and worrying, unless we really got it right the very first time we did it. And then about 7% are doing it quarterly. We asked which of the following methodologies or approaches are most commonly used to set premiums within your organization. So rating tables came in as the most dominant approach. More than 1 in every 2 respondents said that's what they're doing. Regulatory interventions and prescriptions came in at 20%, and then 20% said they actually can and do use flat premiums. GLMs were very, very, very low at 8%, consistent with some of those results we saw earlier around which ones have actual pricing models developed. We asked for which of your products are you most likely to use a short-term pricing model. So that's a full risk-based pricing model, not rating tables, not flat rates. And the overwhelming preference and feeling is towards property, motor, which makes sense. That's by and large where you find large business volumes written. There's also engineering coming through the fold. And yeah, so those are the most dominant ones that we have seen a preference and a leaning towards that. And it might be a reflection of the feeling in terms of where data might already exist. We asked if your organization uses rating factors to set premiums, how many short-term insurance rating factors do you use? Close to 50% of the respondents said it's between 2 and 4, which we found that quite interesting. We would have thought it's a bit more. And then we had 20% that said they would use between 5 and 10. And then 1%, it's one factor. We found that 7% of the respondents only had one factor. So that was quite interesting for us to see.
So then we also asked a few questions around the extent of in-house expertise that they have employed. So first question was, approximately how many pricing professionals or pricing actuaries are employed within your organization? And it was quite worrying to see that, you know, the majority of these insurers don't employ actuaries or pricing professionals. And then the minority would employ 1 or somewhere between 2 and 4. We also asked them how recently or how frequently, or whether has your organization performed any training around the use of machine learning and generalized linear models. And even more worrying response, almost 80% of the, or exactly 80% of the entities or respondents have indicated no, they have not conducted training. So it really does speak to the fact that they also don't really employ a lot of actuaries within the organization. And then we asked a broader question around how frequently does your pricing team, or how frequently does your pricing team attend training? And again, the majority of these respondents say they do not conduct training at all on the subject of pricing. So then we also looked at the main challenges that they are facing. We asked, what is the biggest challenge to your organization when it comes to implementing risk-based pricing? And what we can see, the first 2 bars, lack of expertise and the cost of hiring professionals are actually quite related to each other. So it's quite a big challenge of obtaining expertise throughout Africa to make use of modern pricing techniques. Following on from that, we also see there's a reluctance on the part of the sales force to really accept new terms. So they're reluctant to deal with the complexity or having to explain to one client why their premium is different to the next. And I think that also ties into the next point where we say, where we can see that most of the respondents indicated that the time and complexity of implementation is quite a big challenge because, again, it speaks to many different areas within the business. And then another standalone issue really is lack of clean data, which we ask more questions about which I will discuss as well. So we also asked them on the subject of data, for the purpose of pricing, do you feel your organization has appropriate claims data at an individual policy level? And it's quite worrying to think that 40% of respondents say they don't feel they have enough data, claims data. I mean, they have to comply with IFRS 17 and calculate the LIC appropriately. So I think it ties back to the previous talk. We are not IFRS 17 ready. Then we also asked our respondents, for the purpose of pricing, do you feel that your organization has appropriate exposure data at an individual policy level? So this was more referring to rating factors. Are you capturing appropriate data in terms of rating factors? So here we see a bit of an improvement in the response that 27% feel that they have somewhat sufficient data, and then 60%, the majority, indicates that they feel they do have sufficient exposure data. And then our last question in terms of challenges, is your organization open to receiving training on short-term insurance risk-based pricing and its benefits? So here, the challenge is more convincing management within your institution to really conduct training. And what we can see, which is really encouraging, is that the majority say yes, the organization is open to receiving training, and then 40% are indicating that they would first just want to see what is the value really of having a sophisticated pricing model.
And if we were to look into what insurers are currently doing, the results really look and corroborate what we have seen in the earlier sections. So we've asked the respondents, does your organization currently make use of any specific pricing software? I don't know if you are shocked or not, but by and large, everyone is still relying on Excel. 87% of the respondents said, we are just Excel people. 7% said, look, we are using Python, R, and other open source softwares. And roughly the same also said they are using other softwares. So there is still room for improvement is what we are seeing. And there's still a heavy reliance on Excel-based solutions. We asked whether their quotation software is integrated with their pricing software or are manual updates being made for changes in pricing. Just under 50% of the respondents said it's completely manual. So everything still has to be done all the way manually. 40% said that, look, there is some automation being done, but by and large, they are still doing a lot of things manually. So again, just highlighting that there's room to improve and to automate. We asked the respondents, does your organization have appetite and budget for acquiring short-term insurance pricing software and expertise? And I mean, this is what we typically offer and would put forward as a reason why we don't see some of these advancements and changes in the wider Africa. And so we wanted to put it to the respondents themselves and hear what they say. So it is very interesting to see that it's only 27% that felt that, nope, they probably don't have appetite and or budget. But 13% said they feel they have both the appetite and the budget, and it's probably speaking to some of those cases at roughly 7% where we saw they are already implementing risk-based pricing. And then we saw 60% saying they are keen, they have an appetite for it, but they feel that the budget might be a constraint. And some of the results that we'll speak to in a bit might also help alleviate and address that concern and show the opportunities that exist as far as the monetary side is concerned. So we can get into summarizing the conclusions. So from an implementation standpoint, organizations are predominantly using, sets of rules, tables for their pricing in short-term insurance. The rules are typically updated on an annual basis. Insurers are more likely to only have a new business pricing model. And we found that, by and large, 4 or less rating factors are common practice.
And then in terms of the expertise questions, we noted that majority of respondents do not really employ any pricing actuaries or pricing professionals. So we don't really see any internal training. There's a lack of internal training being conducted. And therefore, there's also really a lack of awareness of the use of more modern pricing techniques. In terms of the challenges, we note that the lack of expertise is actually the biggest hurdle towards making use of modern pricing techniques, and complexity around convincing your sales force to adopt or get on board with your new distribution system, and the complexity around actually implementing it or integrating your pricing with your quotation systems. And then the last big hurdle to overcome is having sufficient data for the purpose of fitting models, and actually having clean data to fit models. We know that clean data doesn't exist, but something approximating that.
And in looking at what insurers are currently doing in practice, there's a lot of room for improvement. And not only is there room for improvement, we have seen that insurers are keen to be assisted and supported on their journey to improving their approaches. Now, the reality is that this was the essence of our talk, the focus of our talk, the survey results. And we have engaged on those, discussed those with yourselves, and this is where our presentation is supposed to end. It only ends that way if you don't have Michaels in your team. I have Michael in my team, and like every typical Michael Jordan, Michael Phelps, Michael Jackson, they just keep going for more. They keep going for more. They demand greatness. And I thought we would be ending here. Michael, why aren't we stopping here?
Those are some big names to live up to. No, I think when we looked at the results of the survey, we could really see that our respondents are actually hungry to see what is really the value of adopting a new, a sophisticated pricing model compared to what they're currently doing, making use of rules or having just charging flat premiums across the board. So we thought we would come up with a case study, an example, and just touch on some of the great benefits of making use of a more sophisticated risk-based pricing model.
So in the pursuit of greatness, looking into the opportunities and benefits of risk-based pricing, there are benefits, from an underwriting standpoint. There are efficiencies that can be leveraged around decision-making and around the underwriting process. From a customer segmentation standpoint, adopting risk-based pricing approaches, you already have within your grasp, segmentation of the customer that enables and empowers you to be a lot more targeted and to direct your efforts and spends from a marketing standpoint. There are benefits when we look at, managing your risk and enhancing your risk mitigation and management approaches, whether it's fraud risk modeling and fraud risk management, etc. The approaches the modern approaches that you can use from a risk-based pricing approach standpoint give you an advantage in this regard and make these accessible to you. And with a focus in the wider Africa, where a big part of earnings are derived from investment returns, there's still a way in which you can utilize some of the benefits and insights that come out of risk-based pricing to still achieve that objective and, in fact, even potentially enhance it.
So looking at our case study or our example, we managed to get quite a substantial data set off the internet. So it's comprised of 677,000 motor third-party policies that were sold in France. All of the policies have a one-year coverage period, and we only had information to the number of claims per policy and the exposure, so we didn't really have information on the severity of each claim. And we fortunately had quite a number of rating factors that we could use to fit a model. So just to mention a few of the rating factors, we had the area, so that's where the vehicle's being parked or where the owner, the insured, actually lives. Then it's the vehicle power, so that's expressed in terms of horsepower. Looking at bonus malus, so it means good, bad, so that's based on the individual's actual historical claims experience. So a low score indicates you haven't really had any historical claims, and a high score indicates you've had quite a poor historical claims experience. And then, vehicle, the engine type, so whether it's petrol or diesel. So having had a look at the data set, we first just calculated a flat premium, and we did so by assuming a nice round number for the severity of 50,000. So, and then we looked at what is the overall claims frequency across the book, and we saw it's about 10.1%. So I just want to highlight something important here. 10%, it means almost 90% of your policyholders are not claiming. So all of your losses are being explained by 10% of your policyholders. If you have a really sophisticated pricing model, in an ideal world, you'll be able to isolate those 10% from the other 90% that are profitable to your business. So then to generate a comparison against flat premiums, we fitted a generalized linear model to retain interpretability of rating factors, but to streamline the process of fitting, we made use of a random forest, which is a machine learning technique. And what it indicated on this data set is actually interesting enough that the driver age is actually the most explanatory variable in terms of the differences from one policyholder to the next. Then following that is region, vehicle power, and the area in which the insured stays. So on this graph, what we have done, we've used the model to predict the risk premium for all of the policies, and we've ordered them from smallest to largest, and assigned and calculated the percentile of the whole book. So on the what you can see on the x-axis is the percentile, and then on the actual graph, there's a point of intersection between the modeled risk premium and the flat risk premium. And it is at that point where you can see everything to the all the way on the graph, from the point of intersection to the left, your flat risk premiums are higher than your modeled risk premiums. And that comes in at around the 70th percentile. So it indicates that for 70% of your book, your premiums are actually too high. And it indicates that if you have a sophisticated risk-based pricing model, you can actually make insurance way more affordable in Africa. And if you think about it, if this is just on your current book, what about all of the people in the market that are not insured yet? So there's significant scope for how these models can actually make insurance more affordable in Africa. Then all the way from the point of intersection to the right, you can see actually your premiums, your flat risk premiums are insufficient to cover the actual or true risk indicated by the modeled risk premium. And to the point that KATLEGO raised earlier around the fact that investment returns is a very important consideration across Africa. So therefore, insurers might be more likely to take on business that they think is borderline profitable loss-making, because they will make up any potential losses through investment returns on their assets. We've actually done some research, looked at the asset returns or the returns on the main asset classes in Africa, and what we've seen is over a 5-year period, the highest returning asset classes have been around has been property and equity, and it's come to around 20%. But now, how do you factor this into your pricing process? And you can actually see very simplistically, if you are mispricing a policy by more than 20%, it means whatever investment returns you're going to achieve on that premium, you're still going to incur a loss. So this is just to illustrate that you can combine the consideration of investment returns within a sophisticated pricing framework. So just in summary, a way in which you can utilize this analysis immediately it will help you identify those segments of the business which are most profitable, those ones which are most loss-making, and those which are profitable or loss-making after considering investment returns. And then even those segments of your business where you might have, in hindsight, rather had rejected those policies because they might be uninsured, or those policyholders because they might be uninsurable. So just looking at the steepness of the model risk premium towards the 99th percentile.
And just focusing on that point that Michael has made around being able to identify your most profitable segments, from that same example that we have done, what this graph here is showing is the average premiums from what we've modeled for different vehicle brands. Now, what you can see from this is with our assumed flat rates that we are charging at 419, vehicle brand B12 is costing us, because we are essentially underpricing for that brand, as we should be pricing it at 503, and we are only pricing it at 419. Now, it then begs the question, how much of our business is in vehicle brand B12, right? So we found that constitutes 33% of the book. And that means that's where you're having a lot of losses being derived from just one vehicle brand. And so already it gives you tools and things that you can engage around interventions you can effect when you consider the size of the book relative to your wider book, but also what it is costing you, whether you want to go risk-based pricing for those sort of categories or not. Same analysis when you look at identification of loss-making versus profitable segments by area or location. You can see there that in area F, we are under pricing for risks in that area. But similarly, when you look at area A, we are significantly overpricing. And again, it can help us in identifying areas where we expend our efforts from a marketing spend, from a targeting standpoint, etc. And so where we have room, we can, in fact, focus our attention to those areas that we find are profitable. And then area F, in this case, we find that at least it's not a very large portion of our book, and that again gives us options. We can say, all right, maybe over time we exit that area, or even if we insure it, we keep it at that level and don't over-invest our efforts in marketing to that area if we are keeping the premium flat at the same level. Same analysis, you can do it by any of those variables. Vehicle power, I think these are the German machines. It's none of my cars. My car is not there at the top. It's probably vehicle power 1, 2, 3, and 6. It's very slow. But there are these German guys who are driving these fast cars, probably the Beamer guys at the top. And you can see we are making big losses with those vehicle power levels. But most of them, at least we are not heavily exposed to them, except for vehicle power 15, where 20% of our book is exposed to that level of power. So this highlights immediate actions that can be taken around whether you're going to increase pricing or rather increase premiums. You're going to choose to exclude certain risks, introduce excesses. We have seen in the wider Africa, you can introduce excesses, but there are guidelines oftentimes from the regulatory bodies around how you do it, ensuring that the same excess applies to policyholders in same categories, etc. But now you have these as things at your disposal to use and to effect. You can devise targeted marketing campaigns, invest efforts focusing on certain distribution channels that you're finding are most profitable, investing more in, or improving the efforts at what we find to be loss-making channels and areas or segments. And then Michael spoke to the potential to decline some of those heavy or excessive risks that you may have on your book, or at least price better for them. So this is us concluding what we wanted to present today, and I think we have 10 minutes, if this clock in front of me is not lying, and I'll check with our hosts for potentially 1 or 2 questions. If it's a culture question, I'll answer it. If it is a technical question, Michael, you brought this up on yourself, okay? All right, to our hosts.
To our audience, our speakers are saying they'd love to have a dialogue with you all. Is there any questions in the... Okay, we do have one question at the back.
Maybe as the mic is going to the back, KATLEGO and Michael, just following from the first session that we had, IFRS 17, are we there yet? Risk-based pricing in Africa, are we there yet?
I don't like echoes, but I'm going to echo the message from the previous panelists. But no, we're not there yet, but the opportunity is there. I think we have dismissed the opportunity with quick assumptions around, there's no data, there's no keenness. But I do think there's a keenness, and it's just around as a community in this space, particularly in the short-term industry, starting to drive those conversations, starting to highlight the potential value that exists, and that's how an industry can actually transform. So we are not there yet. Lots of opportunities, and that's the results now we are actually seeing from the clients themselves, rather than just an idea or something we read somewhere in a paper.
Good. Thanks a lot.
One question here from Zivanai from Liberty. From the survey, it looks like you said 8% of insurers have adopted risk-based pricing. Are there any distinct advantages? Are they gaining more market share in the markets where they operate, those insurers now adopting risk-based pricing? Thank you.
Okay, Michael, if you want to chip in, you can come in. I may not have heard you correctly. I think you said 8%, right? Yeah, 8%. So that's what we saw, 7-8%. Yeah, so that are using GLMs and the like. So from our research, we did not ask a question around that, and I think that's a good point to highlight and to actually investigate going further. But we were not able to infer from the data that we have around and the questions that we've asked around the extent to which they have been able to gain relative to others. But with the general observations being that, larger sized entities typically adopt these approaches. The chicken and egg situation, did they get there because they were doing risk-based pricing, or did they start doing risk-based pricing because they were already large? So it's hard for us to decipher it and to delineate all of that from the standpoint of just speaking to it in general. But I suspect that there will be a lot of value that they are seeing. At the worst, what they have is an option, right? Is an option to go with what the market is doing related to what they're seeing from their models. But because they're keeping to it, it is likely testament to the fact that they're seeing that at least it gives them the right level of penetration and gives them the right level of outcomes from a return standpoint.
Any other questions?
So my question is almost similar to what Zivanai raised, but in addition to that, because I think the success of risk-based pricing, I think largely depends on there being a clear case study that people can see, because we can see the theoretical argument, but if we've got a clear case study of an emerging market leader or someone actually gaining a lot of market share because they've started to use this sort of pricing. Now how do we get to that point? My view is this is sort of a similar opportunity to what we've seen with the likes of Elon Musk, where you've got the actual technocrats now, starting their own entities, and they're showing how these things could be made successful. So I think it's quite a challenge upon us as actuaries. First, to develop our own business units using these concepts just to demonstrate that they work. And also even brokerage firms as well, because I think the chain for short-term insurance includes the brokerage firms, and they're quite a significant stakeholder. Because when I look at large companies that are already established, you've got quite a mountain. Like if you look at, for example, aviation, if you've got a company that's flying Boeing, they cannot just transition to Airbus overnight. It involves a lot of costs around changing their systems and the trainings of their pilots, and those things cost quite a lot of money. So we're probably looking at that sort of challenge or hurdle, bringing in the inertia in these large organizations. So my guess is going to be either new players coming into the market, or maybe a takeover by some technocrat who is actually very bold to actually enforce these things within the market. But the trigger in this whole thing is a demonstrated case of success. Thank you.
That's a very profound point, and thank you for that. I'm very unbiased as a consultant, but we are ready to help organizations that want to adopt risk-based pricing.
I have the mic now, so I can ask now. So my question is kind of a technical question, and it's a little bit layered. So initially, I wanted to ask, how do you really define this risk-based pricing as a problem in machine learning? Because it can be regression, classification, or clustering. And also, going forward in the future, as we adopt these systems, do you think it's kind of necessary for us to have a IFRS type of thing where we have a standard for major institutions? Because they could be saying that they are using a risk-based model, a machine learning AI type of buzzwords, but then they're just using things that are substandard or very, very different. So do you think it's possible for us to have that in the future?
I think IFRS 17 has really demonstrated the importance of having really good data to have accurate financials, especially for short term, where contracts are measured retrospectively. So you have to have data at a granular level, at a per policy level. So I think IFRS 17 will actually help a lot throughout Africa to get insurers to the point where they feel they have sufficient data and credible data to embrace risk-based pricing. Your first question I didn't hear very properly.
Yeah, but he's basically asking, how do you define risk-based pricing in the context, let's say, of machine learning, right? You can use different parts of machine learning, from a classification, from a clustering, etc.
Got it. So I think there are many different ways. It's not limited at all. I mean, a few very simplistic examples. If you have a lot of categorical data, for example, here there was region and there are 15 regions. Sometimes if you have very little data, if you're a small insurer, then the cardinality of the data set is far too high. So you can make use of a machine learning algorithm such as k-means clustering, and you end up with 5 credible clusters with similar exposure, and then you will use them as individual categories when fitting a generalized linear model. So in that way, you still retain interpretability of how risk is different between the different clusters, and if you really want to get a deeper understanding of how those clusters are comprised, you have a look through in your data. Logistic regression is not so much, it's not really used that much in pricing from what I've seen. It's more just linear regression typically from what I've seen, yeah.
I think, I don't know, Jim, just want to check if we are able to take the last question. So we have one last question there because of the 2 minutes left. I've also been told that I'm not good at marketing. I'm trying to improve that. So I'll ask the technical team to put our last slide up as we take the last question.
Hi, KATLEGO and Michael. Thanks so much for the insights. Jesse here. Just a quick question on specialist pricing software versus R or Python. I mean, I know some of the largest insurers prefer to build up from scratch using R or Python, probably a bit more time intensive. What is your view, I mean, from the clients you've seen of using specialist pricing software or open source, assuming you have a large team with the expertise to build models from scratch?
It's a great question. Thank you, Jesse. I think the big difference is, I think for a large institution or large organization, it makes a lot of sense to have sophisticated software, especially if the software has the capability to integrate with your quotation software. That is a great benefit in the sense that, you know, it removes a lot of the human element where things can go wrong when implementing a new model. But these software does come at a price. So it is something that might not be as accessible to smaller insurers. And then software like Python and R, which is free to everyone, is probably the best starting point for Africa.
And just as to close, now that we've just reached 0-0 on our time, so for us, I mean, the reason I asked them to put up our marketing slide is more for you to contact us. We're still looking for respondents. So if you want to just add to the value we're trying to create in this regard, please just take up our details. We'll be in touch with the survey link, and you can complete that for us. From a next steps standpoint, we're keen to see what that picture will look like, and also from what we do in our space, keen to assist any organizations that are interested and keen to explore this in whatever they're doing in the rest of Africa. So thank you for your time. Thank you for engaging. We really appreciate it.
Thank you. Thank you so much, KATLEGO. I know you put the last slide for us to contact you, but I can see why you insisted. Those are very good-looking pictures. Don't you guys agree?
Indeed.
Thank you so much. Any insights from you, from Simba? This has been such an incredible morning.
It has been. Thanks a lot. Afternoon, actually. I don't know if you're still in Ghana or
I'm still with Florence in Kenya.
I see it. Look, I think as KATLEGO put it, I believe there can be a MEC too on this one. Number one, you mentioned around the fact that they are looking for respondents. I think there can be more data, and with that more data, a bit additional data, we can see a bit more insights into this exercise, and hopefully we can get there in terms of risk-based pricing in Africa. I do look forward to Michael and KATLEGO coming back again with another session next year.
Thank you. To our audience, I'm sure you'll find it no surprise that we're sharing a notepad here, and Simba's already asked me, the coffee break, are we there yet, Nkrumah? And so it is with immense pleasure to let you and Simba know that for the next 30 minutes, we'll take a break. Please do interact, network. We're looking forward to meeting you, getting to know you, and we'll see you back in the room for more exciting discussions and presentations. Thank you.